And first quarter earnings season rolls on. It's a mixed picture from financials today between M&T Bank, State Street, and Charles Schwab. Banking giants in the U.S., including J.P. Morgan, Wells Fargo, and Citigroup, all reporting better than expected profits in the first quarter, despite the banking turmoil seen in March. But the question lingering is that banking crisis over? Here to discuss is Huw Roberts, Quant Insight Head of Analytics. Huw, thanks so much for joining us. So is the banking crisis over?
I hope so. It does feel like it's largely contained. And although they have their detractors, I think you have to give credit to the Fed and other authorities for the speed at which they moved. I think maybe the debate now has probably moved on to the extent that we're seeing the big bank, kind of small regional bank divide open up. And that's what this week's earnings will be so critical on. And I think in particular, what we need to be watching is really the kind of forward guidance from the small and regional banks to give us any clues about whether they are tightening credit conditions and lending standards. And that will feed into the debate about how severe any potential credit crunch might be.
Good to see you. So last week we got J.P. Morgan, Wells Fargo, we got Citi today, State Street, M&T, and Schwab. Is there one trend that you've been watching, one lesson that we've learned thus far?
Yeah, so if you remember, we come exclusively from a macro perspective. So we're very different to your traditional kind of bottom-up company fundamental view. We look at everything from a macro top-down perspective, and we're 100% quantitative. It's all about a smart AI machine. So the takeaways for us so far was that the big banks, most of the big banks, screen as cheap to macro. So although everyone's got excited about the details of the J.P. Morgan numbers on Friday, our model actually showed that JP went into those results 9.5% cheap to the macro environment. So for us, Friday's price action was really just about catch up to macro conditions. To the question you posed at the start, does that mean that the JP Morgan numbers are a template for the broader sector? Sadly, it's not as clean cut as that. So if we look at the big banks, something like Bank of America is not in a macro regime, so that's much more about the idiosyncratic news. But something like Morgan Stanley is very much a macro play and has the same profile as JP. Macro conditions are improving. The sell-off in March has taken it to cheap levels. So something like Morgan Stanley would be our preferred catch-up trade right here, right now.
Huw, the NASDAQ is up about 15% year to date. We've seen communication services, technology stocks rallying in the first quarter. Of course, financials, because of the financial turmoil as well, under pressure for the first quarter. So can the banks really continue to lag if we continue to see an equity rally?
Yeah, I think that's almost the most important question for equity investors at the moment, because it does feel like the elastic on a lot of those kind of relative value plays is becoming very stretched, whether you're looking at growth versus value, or NASDAQ versus S&P, or NASDAQ versus small caps, or at the sector level, XLF versus XLK. All this stuff suggests that, you can make a very strong narrative about how tech was massively beaten up in 2022, how falling bond yields obviously provides a tailwind, and that some of the mega cap techs offer a safe haven dynamic in times of uncertainty. So that there are good stories around all these plays, but it does feel like a lot of that is in the price now. So I think from a tactical asset allocation perspective, yes, I'd agree with your observation that really you've got to see either you need to see some catch up from the cyclical side of the market and a greater breadth there, or we could be at risk of tech actually catching down. Or another way to put it is, given we're in earnings season, I think it's fair to say that the bar is pretty high for tech earnings results. The onus is on them to come out with some pretty good numbers.
So again, you mentioned the NASDAQ, which is still up 15% year to date, and that may be on just playing catch up from last year, or perhaps it's on the thought that the Fed cuts rates later this year. What's your numbers tell you on that, and is there still more room to run for some of those big tech names?
Yeah, so we're in a bit of a tough bind on that, because the way we look at things is the first thing we do is we calculate macro warranted fair value. So the machine looks at where economic growth is, inflation is, credit spreads, the dollar, all these macro variables, and computes a fair value for any particular instrument. Now, the good news for tech bulls is that is still pointing higher, that macro conditions are favorable for tech. The bad news is that at these levels, again, tech has run ahead of that improvement, and they're trading rich to our macro models. So on that basis, I think the way we would conclude it is these are not good levels to chase technology. Yes, they have strong underlying stories, but these are not optimum entry levels at all.
And Huw, do you think that the investments that tech companies are making in AI, for example, which has been a hot topic of conversation, is going to further impact bottom lines?
Yeah, again, excellent question. I think that's that secular growth story, I think, has to be a big part of the price action in the last couple of months. The hype around generative AI is so big; it's such a potential massive game changer. That has to be part of the rally. Again, we would just question the degree to which it's already in the price at these levels. But I think, the trouble is valuing something like that is just so tricky. So again, I think we would just kind of fall back on the point that, I think Meta might be a good kind of case study to look at. The feedback from Meta has been that this is a year of efficiency. It's a year of cost savings. They're going to try and help the bottom line that way. And now you see they seem to be taking a quiet pivot away from augmented reality and VR and maybe towards more AI. I think that speaks volumes for where the focus is and where the top line growth may potentially come from.
All right, great stuff there. Huw Roberts, Quant Insight, Head of Analytics. Good to see you, sir. Thanks for all that.